Ever wondered why you were rejected for a credit card, even with a good income? It feels random, even unfair. But what if I told you banks aren't looking for reasons to approve you? They're looking for reasons to say no. This isn't personal, it's systematic. You've done everything right. You filled out the application. You have a steady job. But the decision that comes back is a rejection. It's a frustrating experience that leaves many people confused. You might think, don't they want my business? The truth is, the process has very little to do with what a human banker thinks of you. Your application isn't being judged by a person. It's being processed by a machine. Banks rely on highly sophisticated automated risk systems. These systems are designed to do one thing: calculate the probability that you won't pay them back. It's a cold, hard calculation of risk. Understanding this system is the key to getting approved. So let's pull back the curtain and see exactly how this machine works, step by step. First, your application is received. An automated system immediately checks your personal information for completeness and accuracy. It verifies your name, address, and social security number against massive databases. Any mismatch, even a small typo, can cause an instant rejection before a human ever sees it. This is a basic data integrity check. Next, the system makes a crucial move. It pulls your credit score. This is a hard inquiry that appears on your credit report. The system requests your credit history from one of the major bureaus like Equifax, Experian, or TransUnion. It isn't just looking at the 3-digit score. It's analyzing your entire payment history, how much debt you carry, and how long you've been using credit. Then comes income verification. Banks don't just take your word for it. Their systems use complex models to estimate if the income you stated is realistic for your job title, industry, and geographic location. They might also cross-reference it with data from other accounts you hold with them. If your stated income seems unusually high, it raises a red flag for the system. After verifying your income, the system calculates your debt-to-income ratio, or DTI. This is a critical metric. It takes all your monthly debt payments, mortgages, car loans, student loans, other credit cards, and divides them by your gross monthly income. A high DTI suggests you might be overextended, making you a higher risk regardless of how much you earn. Here's where many people get it wrong. They believe a high income is the most important factor, but the system values something else more: low-risk behavior. A person earning $50,000 a year with a low DTI and a perfect payment history is often seen as a better risk than someone earning $200,000 with high debt and a few late payments. The system isn't impressed by your salary. It's impressed by your financial discipline. Now all this data feeds into the bank's internal risk engine. This is the secret sauce. Every bank has its own unique algorithm. It weighs every factor according to its own risk appetite. For example, one bank might be looking for customers with very high credit scores, while another might be more willing to lend to someone with a shorter credit history if their income is stable. This is why you can be rejected by one bank and approved by another on the very same day. They are running different programs. Finally, the system makes a decision in milliseconds. It's either an automatic approval, an automatic rejection, or a flag for manual review. Only a small fraction of applications are ever seen by a human. A manual review usually happens when the application is borderline, not a clear yes or no. In this case, an underwriter will look at the data the system flagged to make a final judgment. So, getting approved for a credit card isn't about convincing a person that you're trustworthy. It's about fitting the ideal customer profile programmed into a machine. The rejection isn't personal. Your application simply didn't match the specific risk parameters the bank was looking for at that moment. Understanding this process gives you a powerful advantage. You can now focus on what the system actually values: a clean credit report, an accurate application, and a healthy debt-to-income ratio. You're no longer guessing. You're navigating the system with clarity. And that is the first step toward your next approval.